Investing is a powerful way to build wealth over time, but it is also fraught with potential pitfalls. Whether you are a seasoned investor or just starting, there are common mistakes that can undermine your financial success. This guide focuses on 5 critical investment mistakes that could be standing between you and your wealth-building goals. Avoiding these errors can improve your returns, reduce risk, and ensure that your financial strategies are as effective as possible. Number 1. Failing to diversify your portfolio. One of the most fundamental principles in investing is diversification. Many investors fall into the trap of putting too much money into a single asset or asset class, believing it will offer the best returns. However, concentrating your investments in just 1 or 2 areas exposes you to unnecessary risk. The value of a stock, bond, or real estate investment can fluctuate due to various factors, including market trends, geopolitical issues, and company performance. When you focus all of your investments in one place, any negative event can have a significant impact on your overall financial situation. To mitigate this risk, it is essential to spread your investments across a variety of asset classes. This may include stocks, bonds, real estate, commodities, and even alternative investments like cryptocurrencies or private equity. Diversification helps balance out the fluctuations in individual investments. For example, while stocks may experience volatility, bonds or real estate investments can provide more stable returns, thereby offsetting losses. Over time, this balance will reduce the overall risk in your portfolio while still providing opportunities for growth. Diversification should also include investments across different sectors and geographic regions. This reduces exposure to sector-specific downturns or regional economic crises. International investments offer exposure to growing economies, while sector diversity ensures that you are not overly reliant on any one area of the economy. Building a diversified portfolio requires careful planning and ongoing monitoring, but it is one of the most effective strategies for long-term investment success. Number 2. Chasing after high returns without considering the risks. High returns are enticing, and many investors are drawn to risky assets like high-growth stocks, speculative investments, or leveraged products that promise massive gains. However, this approach often overlooks the potential downside risks. The allure of quick profits can cloud judgment and lead to investments that are ill-suited for your risk tolerance and long-term goals. Chasing after high returns without thoroughly understanding the risks involved can result in significant losses. For instance, high-growth stocks, especially those in emerging industries like tech or biotech, can offer substantial rewards, but they are also highly volatile. Similarly, speculative investments, such as cryptocurrencies or meme stocks, can experience dramatic price swings that lead to substantial losses. When you chase high returns, you risk jeopardizing your financial future if these investments fail to meet expectations. The key to successful investing is finding the right balance between risk and reward. While it's natural to want to see your investments grow quickly, it's essential to understand that higher returns come with higher risks. It is important to assess your personal risk tolerance, consider your financial goals, and understand how much volatility you can handle before making investment decisions. Rather than chasing after high returns blindly, focus on building a portfolio that matches your risk appetite and provides long-term growth potential. Number 3. Ignoring the importance of rebalancing. Over time, as market conditions change, your portfolio can become unbalanced. Some of your investments may grow faster than others, and certain assets might underperform. If you do not periodically rebalance your portfolio, you may find that you are overexposed to risk in some areas and underexposed in others. For instance, if you have a large portion of your portfolio invested in a stock that has performed well over the years, it may account for a larger percentage of your overall holdings than initially planned. This can lead to an imbalance where you are relying too heavily on one asset class, which can increase risk. On the other hand, bonds or international investments that have not performed as well might make up a smaller portion of your portfolio, leaving you underexposed to stable or growth-oriented assets. Rebalancing is the process of adjusting your portfolio to maintain your desired allocation. It involves selling some assets that have grown too large and reinvesting the proceeds into underperforming areas that need more exposure. Rebalancing helps ensure that your portfolio remains aligned with your long-term financial goals and risk tolerance. Many investors set a schedule for regular rebalancing, whether that be quarterly, semi-annually, or annually, to make sure their investments continue to match their overall strategy. Failing to rebalance your portfolio can result in unintended risk exposure. For example, if you do not rebalance after a strong year for stocks, you may be overly invested in equities, leaving your portfolio vulnerable during a market downturn. Similarly, not rebalancing after bonds have underperformed could mean you miss out on an opportunity to benefit from growth in other areas. Rebalancing ensures your portfolio stays diversified and appropriately adjusted for your goals. Number 4. Letting emotions drive your investment decisions. Emotions are powerful forces that can significantly impact investment decisions. The stock market can be volatile, with prices swinging up and down in response to both market conditions and news events. During periods of market turbulence, fear and greed can drive investors to make irrational decisions, such as selling in a panic during a market dip or buying into hype during a market rally. Both of these behaviors can undermine long-term investment success. A key strategy for avoiding emotional decision-making is to automate your investments. Setting up automatic contributions to retirement accounts or brokerage accounts ensures that you continue investing regularly regardless of market conditions. This prevents you from making decisions based on market timing or emotions. By maintaining consistency and sticking to a well-thought-out strategy, you can reduce the likelihood of letting emotions influence your investments. Number 5. Overlooking fees and taxes. When it comes to investing, fees and taxes are often overlooked, but they can have a significant impact on your long-term returns. Many investment products, such as mutual funds and exchange-traded funds, ETFs, charge management fees, which can eat into your profits over time. Additionally, taxes on capital gains, dividends, and interest income can reduce your investment returns, especially if you do not consider tax-efficient strategies. One common tax-efficient strategy is to use tax-advantaged accounts, such as individual retirement accounts, IRAs, or 401ks, which allow you to defer taxes on your investments until you withdraw the funds in retirement. Additionally, investing in tax-efficient funds, such as index funds or tax-managed funds, can help reduce the tax burden on your portfolio. Minimizing fees and taxes is a crucial aspect of effective investment planning. Investing is a long-term endeavor that requires careful planning, discipline, and a clear strategy. By avoiding the common mistakes of failing to diversify, chasing high returns without understanding the risks, ignoring rebalancing, letting emotions influence decisions, and overlooking fees and taxes, you can improve your chances of achieving financial success. Building wealth through investing takes time, but with a thoughtful approach, you can reach your financial goals and secure your future. Remember, the key to successful investing is understanding the process, sticking to your plan, and making informed decisions that align with your risk tolerance and long-term objectives.